welcome back to Climate Transformed, and what is effectively, I would argue, the soft launch of the Climate Transformed VCM series, which we intend this to be a 50, 60 hours of content over the course of the next 12 months or so with live events and whitepaper releases like we're doing with Thallo today. But I couldn't have thought of a better sort of partner to do our soft launch with than Thallo, which is it's a Web3 carbon marketplace, which I will do no justice to. So I'm going to let Hayley and Nathalie talk about that in just a moment. But today we're sort of here talking about sort of a white paper that Thallo is releasing today with us on pre-financing and the challenges of scaling the BCM. So I'm here with Hayley Moller from Thallo, with Nathalie Beken who's an analyst at Thallo, who's calling in from Seoul. Is that right, Nathalie?
That's right, Paul. Yeah, that's right.
It is super late for you, so I'm not going to talk for long. So I'm going to get started. Everyone, same rules apply. I have no monopoly over good questions, so please pop them into the chat at the bottom of the screen. Hayley, I'm going to start with you before you dive into your presentation. I could not do Thallo justice. Can you please do that for me?
Sure, yeah. Although I know folks are really here for the meat of the report, so I'll be very brief. First of all, thanks, Paul. Super excited to be here. By way of introduction, I'm Hayley Moller. I'm a member of the founding team at Thallo and head of marketing. I've got about 15 years of experience in the climate and sustainability realm, starting with a degree in environmental science, and most recently with an MBA from INSEAD here in France, where I'm calling in from. I'm super excited right now about the potential for the voluntary carbon markets to really buy us time as we head towards even deeper decarbonization. I think that's sort of the key role that the voluntary carbon markets can and should be playing. So about Thallo, we think about ourselves as the future of climate tech innovation. We've got a team of sustainability experts and blockchain entrepreneurs, and we're working to really disrupt the voluntary carbon market. Our flagship product is the Thallo Carbon Exchange. This is a platform that we will be launching very soon to allow businesses and individuals to be able to purchase, retire, or trade, or in the cases of project developers, sell carbon credits. Our platform, as you mentioned, is a Web3 platform. That just means to us that we use blockchain technology as part of our platform. And we do that to help solve some of what we see as the biggest challenges in the market around things like fragmentation, value sapping intermediaries, opaque data and low data access, and inefficient transactions that happen between project developers and ultimately the end buyers. One thing that really sets us apart is that we are highly focused on the project developers themselves. So these are the entities that are on the ground who are actually implementing the projects that sequester or remove or avoid carbon from the atmosphere. A couple of ways that we're doing this is our platform has, and this is enabled by Web3, our platform will be launching with an NFT royalties model. So this is essentially so that in a secondary trade scenario, some of that revenue goes back to the original project developer. And also looking at how to accelerate financing for early stage projects. As we were just talking before the panel started, this is one of the key challenges in the market. So when we started out, we had some pretty basic questions about the market, like what are the biggest bottlenecks that project developers are facing? What is the cost of those bottlenecks? How much money are the intermediaries capturing in the middle of the market? And how many carbon credits aren't being issued because of solvable problems or delays in the carbon credit supply process? We were pretty surprised to find that these answers weren't readily available. So we went out to find them and figure out what's actually going on. So that's where Nathalie comes in. She's a current MBA at INSEAD and an analyst at Thallo. And she spoke with folks from really all across the carbon markets to get some of these answers. And that's what we will be excited to present to you today. In the meantime, if you want to check out the report while Nathalie is going through her findings, you can find it at thallo.io. That's THALLO.io under the report section of the website. And feel free to follow us on Twitter as well at Thallo_IO. So with that, a little bit about Thallo, a little bit about me, I will hand it over to Nathalie.
Thank you so much, Hayley. And yes, let's dive into the report immediately. Give me a second, I will share my screen. All right. So the name of the report that we're going to talk about today is Fast Forward, Challenges to Scaling the Voluntary Carbon Market. And the report basically consists of 4 parts. In the first part, we dive into the development process of a typical carbon project. Next, we speak about financing methods. We look at most occurring methods and which methods are actually the best for the different types of project developers that I've talked to. Next, we dive into the value chain and we focus on repartition of revenues in that value chain. And finally, we'll speak a bit about forward financing. First part, development process and sources of delay. So I think most people attending this webinar will know basically what the development process looks like. But there are 5 important steps that we'll quickly go through. First, there's a pre-feasibility stage where developers just check how feasible the project is and if there's really any carbon credits to be developed. Next, there's a huge stage where they draft the PDD, which is the project design document. In this document, they basically describe the full project from top to bottom, make some basic calculations, calculate how much carbon should be offset, and gather all the data to prove these calculations. When the PDD is ready, it gets audited, and the goal is that it gets registered by a greenhouse gas crediting program. And this is something that can last a long time, as we will see soon. And finally, when the project is registered, then actually you have to start proving what you described in the PDD actually works. And so you have to start implementing, and you have to measure what you're implementing, and then gather all this information in a measurement report, which then is again checked by auditors and sent to the greenhouse gas crediting programs. And once they've checked that everything you've done is valid, they will issue the credits. And so this whole project can last for a very long time, or can be very quick, between 1.5 and 6 years. And in parallel of the 5 steps I mentioned, project developers are usually quite busy securing funding and, of course, doing the actual project implementation itself. And so in the dozens of interviews that I've organized this summer, I've asked project developers, now, what are the biggest bottlenecks and what are the biggest sources of delay in this process? And the resounding answer from most of them was, well, it's the delays at the greenhouse gas crediting programs, also called the registries, most often. And yeah, I've added a few of quotes that they've told me for you to get a feeling of what they're struggling with. And they say, consultants and registries take a lot of time. We wish we could set a timeline for them. The problem is that all big developers poach employees from the registry, so it's really a human capital program. But then we've dug a bit deeper, and we've also heard things like, well, it's hard to book available VVBs and they take a long time to execute. So they're probably also responsible for part of the delay. And yeah, that the registries also lose time because there's such a big variety in the quality of the work of the VVBs, and it's not always as good and maybe even declining. But for the project developers, it's really annoying. One of them has said, for instance, we work with national standards for some of our projects just because it's quicker. And it's not necessarily a lower quality or a less strict process, but they still have to sell their credits at a lower price because the reputation of the national standard is just not as good. And then besides the verification delays, such as the registries, the VVBs, and data collection, there is another important barrier, that is financing. We'll dig into that later. So we've tried to quantify these verification delays, and we've come to see that these delays until 2030 could result in 4.8 gigatons of fewer credits being issued and developed. So this is a huge cost for the planet. And it's also a cost for the project developers, because many of them agree that if these bottlenecks get solved, credits could be issued twice as fast than they are now. So that's a huge cost for them. And I'll share how we have come to these numbers. So there's, on the left graph, you see the number of credits that have been issued between 2015 and 2020, and then a few different scenarios, projected scenarios of how these issuances could grow until 2030, where the top exponential growth is taken from the optimistic ICVCM scenario. But if the registries and the VVBs don't manage to scale their activities faster than they were doing up to now, we could stay with the gray line, the business as usual line, meaning that there's 4.8 gigatons of credits that could not be developed until 2030. And the problem is really that project developers, not only that they not get verified by the crediting programs, but also that the project developers cannot sell them as long as they're not issued, so they don't get any revenue, so they don't have any money to invest in the next project. So it's really not only a verification problem, it's really a development problem. And yeah, for the project developer, as I mentioned, this having to wait for verification and registration is really a source of demotivation for the core teams, but also for the local communities who are implicated in the project. They have to find other means of funding to pay for their OPEX. There's no cash to start the next project. And sometimes the co-benefits cannot materialize until they're starting to earn the revenue from the projects. So yeah, this all together could cost them 2.6 billion until 2030. Now, there should be a solution to all of this. And the solution lays with the greenhouse gas crediting programs, but also with the VVBs. Because we've looked into this and we've discovered that there's actually a huge correlation between number of credits issued in the past few years and number of VVBs that are accredited, as you can see on the top right graph. And there we have heard the registries. We have shown them these results, and they're arguing that while the problem is not entirely their fault, there's also a part with the VVBs because there are too few and the quality of what they deliver is declining. But of course, they know that they also have a role to play. So Verifying Gold Standard, they have published statements about this, and they're working hard with VVBs, giving them training and with national accreditation entities to improve this. Besides the crediting programs scaling up and better cooperation with the VVBs, there are some other possible solutions to solve this problem. One of them could be agreeing on baseline methodologies across big and small crediting programs. And this would result in the fact that it's easier for all market participants to develop credits. And on the other hand, also the smaller registries could maybe gain some reputation and take part of the work from the bigger registries. Besides that, there's some newer or more modern crediting programs that are arguing that the Verifying Gold Standard methodologies are too complex and sometimes just not applicable to the third world or the developing world where these projects are often being done. And so they argue for increased flexibility in methodologies without, of course, compromising for quality. A final thing is improved technology like digital MRV, dedicated software, because the big and established project developers, they often have dedicated software for the PDDs and the measurement reports. But for the smaller developers, it's often a lot of manual work in spreadsheets, etc. So if they could get access to the software, that would be great. And finally, there's also blockchain as a solution. And jurisdictional baselines could also help in the sense that baseline calculations are very complex, both for the developer who has to write the PDD and the registrar who has to check them. So if we could use jurisdictional baselines, this would be a big help. Moving on to financing, it turns out that many project developers, most of them actually use some kind of forward purchase agreement to finance their project, but also in combination with own capital, because they don't always need a big sum of money at the beginning of the project. They often start doing the pre-feasibility and registration with their own capital. And as soon as project implementation starts and they have some more certainty about the issuance of the credits, they will start forward selling their carbon credits. Besides this, there's also some cases where they've used direct equity, grants and donations, or debt. I've also, in the main report, the full report, there's also pros and cons and exact definitions of what these financing methods mean, but you'll have to check out the report on the website if you want to know more. But basically, what's important to know is that these forward agreements are very different. Everybody has described them to me, and none of the forward agreements that I've heard about were the same. So there's a huge discrepancy and very low transparency about how this actually works. And of course, it's easier for established project developers to get some funding and forward financing than for the smaller project developers. And this is really a chicken and egg situation because they are the ones who need it most. Yes. And yeah, actually, this is what I was saying. So the preferred way of financing depends really on the type of project developer and of course on the capex intensity of the project as well. But so for the big and experienced project developers like EcoSecurities and South Pole, it's not a real challenge to find funding because they have a great reputation and if companies want to buy carbon credits and forward pay them, they will do it without taking too much risk. Then you have the intermediate project developers who have typically already developed 1 or 2 projects, but they're not as big as the other ones. They like to keep full autonomy. For them, that's very important. And they don't necessarily need a lot of money, but they would just like to have a guarantee that at least part of the credits that they are developing will be sold. And then finally you have small and new ones, and they really haven't developed any project before. So they really need to prove themselves, and they are the ones who need starting capital most. But here, as we were saying, everything really relates to the risk of investing in these kinds of developers. Then moving on to value capture along the value chain. These are basically the 2 main diagrams that we want to talk about here. You see just kind of a flow of the worst case and best case of how the money flows when you buy a carbon credit. So in the worst case, you buy the end buyer buys a carbon credit from an intermediary. And here, a comment about intermediaries. Not all intermediaries are bad. There can be good intermediaries who really have a high value add and don't take too big of a markup. But there's also bad intermediaries who take huge markups and don't really add a lot of value. So in the worst case, that's the case. Let's say they take 100% markup. Then with half of the price of the credits, the project developer has to, so that's his revenue, and he has to pay for development and implementation costs and registry fees, repay his investors, and only keeps a small amount of profit for himself and to invest in a next project. Whereas in the best case, the end buyer buys directly the credits from the project developer, and he has a beneficial financing scheme, so it doesn't have to repay the investor that much. Of course, the development and implementation costs stay the same, but he has more profit, and a lot of money can be reinvested in local communities or co-benefits or into next projects. So that's really the best case. And what's important to understand is that, of course, in the market, everything in between these 2 cases is possible. And so probably on the market, there will be an average of these 2. And this is also how we've come to the finding of the 650 million. So the value of the voluntary carbon market in 2021 was around 2 billion. And the average price of credits being sold was $4. Now, assuming that investor repayments could be reduced from 28% on average to 10% on average, this could decrease the carbon credit price by 70 cents. And then assuming that 35% of credits are directly sold to end customers, 50% are sold to good intermediaries who take reasonable markups, and then the rest is sold through bad intermediaries. This again could account for 60 cents per credit. And if you combine these 2, that means that credits could be actually sold for $2.7 per ton instead of $4, without reducing anything in the quality of the credit. It's just less money going to investors and intermediaries. So if you make the maths from the 2.7 to the $4 per ton across the whole market in 2021, where 500 million credits were sold, this accounts for 650 million in 1 year only. And so you could start wondering, why do the project developers and work with these brokers? And yeah, they've said it's just to help us connect to buyers because we cannot find them. It's also convenient for price discovery because we just have no idea. And some right away say that they use them to sell less qualitative credits. But this is really the value of a well-functioning exchange that can solve all of these problems. And then moving on to the final part about forward models. We've talked a lot about these forward models, and we've said no 2 agreements are the same. And everybody is talking about futures and forwards, but people are already a bit confused. What are futures? What are forwards? So here, back to basics, we've put down some definitions. So future contracts are really standardized contracts that are traded on exchanges. So they're settled daily. They have fixed maturity dates. There's little risk because it's the exchange who takes the guarantee on the payment. And paradoxically, the futures, their vintages are not in the future necessarily. Often they are not. Wherever OTC forward contracts are arrangements that made over the counter, so between 2 parties, which of course makes them come with a higher degree of risk. But here the vintages are in the future, and actually these forwards are much more relevant than futures into help accelerating the market, because the projects are inherently different. These forward contracts can be closed much earlier in the life cycle of a project, so they can really provide this much needed financing. And actually, that's also what we've seen in Ecosystem Marketplace in their latest reports, that 65% increase has occurred in forward transactions between 2020 and 2021. And so we've done some research. There are a lot of Web3 projects in the space of forward markets, and we've compared them on the slide. Our favorite one was Ivy Protocol, because we think that they really help to accelerate the market, because they don't pull credits, and they want, so the projects that are eligible to come onto their platform are very early projects, even before pre-feasibility. And of course, there's a lot of risk. The way they de-risk is they work with small ticket sizes. They work with donations as a buffer. They rate developers, and they give funding to the developers in tranches, meaning they have to hit some milestones before they get the next tranche of money. Project developers can go surf to their website and get funding in a matter of days. And what's interesting to know is that Ivy Protocol has their own pool of validators and specialists that really help these early stage projects get to registration, pre-feasibility, and validation stages. So we've also looked at many other projects that you can take some time to look at later in the report. And finally, there's futures that are being traded on exchanges like CBL and ICE. These futures are a pooled approach. You can have different kinds of pools, and the vintages, as you can see on the figure in the right, they're in the past. The registries are also doing things into this aspect. So they have both come up with something like a projected carbon unit or a planned emission reduction, which is basically a tradable product. As soon as a project has been registered, you can also already start trading it, but you cannot retire it. So there's already money flowing to the project after registration. So this is great. This is a step in the right direction, but in our opinion, it's still not early enough that the money flows to the project. So really, to make a difference in accelerating the market, you need to give funding to these early stage projects even before registration, because after registration, it's not so hard to secure the necessary funding anymore. In the main report also, we've done a proposal for a forward model that we really like. So if you're curious, I recommend you to check it out. But basically, we've discovered the market is changing rapidly and there's many challenges left, but mainly it's scaling this verification process and improving access to early stage financing. And so this is really a call to collaborate, because the more we collaborate, the faster we can get global emissions to go down. So we'd love to discuss this further once you've read the report. And also excited to open the Q&A right now. Thank you so much for listening.
Nathalie, thank you. Thank you so much. If you wouldn't mind just sort of giving us back the screen so we can see both of you. Hayley, I'm about to say something which will make you giggle, because it sort of sums up so much about the world we live in, right? Why are venture capital firms all run by people who look like me, right? And the answer to that question is because middle-aged white guys are the sort of people who can afford not to get paid for 6 years before they actually get through. They see some revenue from their investments, right? And Nathalie, when you're talking about this 1.5 to 6 year process of approval and all this sort of stuff, all that was going through my head is that the only way that you can actually fund projects for long periods of time without seeing any revenue at all is if you're a rich white guy. That was all that was going through my head through this entirety of your call, of your presentation. And it made me sort of think about, the whole notion of forward selling and all this sort of stuff. It's great, right? And it will accelerate the process forward. But it doesn't solve the funding mismatches that are apparent in the early stages of the development process. So talk a little bit about the way that you are seeing this, that Thallo is looking to solve for that early stage funding. So let's be clear: the $300,000 that you have to send to Gold Standard and Vera in the early stages of the development process, that clearly has to get funded from somewhere.
Yeah, I mean, you're exactly right that the majority of the funding for carbon credits comes from the global north, and the majority of the carbon credits themselves come from the global south. So there is this sort of flow of capital and then flow of carbon credits that has a very specific sort of geographic and economic footprint. I would say that the key there is to get rid of some of those layers in the middle and have more direct contact between the end buyers, the people who want the carbon credits, and the sellers of the carbon credits who are actually generating them. The reason a lot of the intermediaries exist is partly because what Nathalie said, that there's a value to the project developers to be able to offload their credits quickly. There's a value to the buyers to have somebody else put a seal of approval on those credits. Because there is reputational risk with purchasing carbon credits. But what we're seeing is that corporates are starting to get much more educated and savvy in their own departments about buying carbon. And so if you can make a better decision in-house, then it's much more valuable to get connected directly to a project developer, and you don't need those intermediaries in the same way. So our platform is all about making those direct connections. Initially, we will be allowing for folks to buy and trade carbon credits that have already been verified by a registry. However, one of the things that we're looking at spinning up very early are some of these types of funding arrangements where you can actually go in and fund a project early on in order to receive later delivery of carbon credits. It's hard to do that for a number of reasons, a lot of which are captured in this report. So initially, we're sort of looking at OTC setups for that, but you could envision a future in which the buyers and the sellers have both gotten sufficiently upskilled in terms of how to structure these types of agreements that they can become much more standardized and much more efficient over time.
Right. My God, what I'm about to say, I can talk for an hour about this. So how do I get this into 30 seconds? So the whole notion of risk, right, in terms of a project, right, is very similar to the path of an angel investor all the way through to, to an IPO of a company, right? So in the earliest stages of an investment for an angel investor, right, they are taking the most risk, and that is definitely the case also with a project, because you don't know at day one, whether or not this project will be approved, whether it's actually doing the things it's doing, right? So talk a little bit about the ability for firms to fund at that very, very early stage, right? Because I see a real disconnect in terms of the scalability of VCM, because you don't have billion-dollar asset managed project development firms doing this stuff, right? The dirty little secret in VCM is that the biggest asset manager in the world has less than dedicated VCM asset manager has less than $300 million, right? It's a bit of a rounding error. So talk a little bit about the idea of how we fund this stuff at the earliest of early stages, where the risk is the greatest, right? And that obviously, that's the point in time where you have to convince vulnerable communities to get on board with this sort of thing. So how do we solve for that initial funding phase?
Yeah, I think Nathalie probably has some points to make here, but I'll just start by saying also, one important clarification is that there's two types of investors in carbon credits for the most part. There are investors who are investing so that they get carbon credits or carbon credit revenues in the future. So they're investing to make a return. And then there are carbon credit investors who are investing in order to get the carbon credits to retire for their own sustainability initiatives. And for that second type of investor, I would argue that while it's extremely important for them to be able to show that they have compensated for their carbon emissions and make a claim around that, it for them is largely a reputational game, and it's largely in many cases a marketing approach. So if what they're doing is funding a very early stage project, that may actually have just as much value to them as saying we've compensated for our emissions, even if the project doesn't work out. So the risk profile for those two different types of investors is a little bit different. I would say in terms of the question that you asked, there are increasingly certain types of services being provided around that early stage, including insurance and due diligence. I think Nathalie can talk a little bit about some of those. And then I think the other piece is around kind of creative ways of hedging against that risk, like what some of these Web3 projects are doing, like having a donation-only buffer pool that can compensate for a moment in which carbon credits are not delivered. Nathalie, did you want to add to any of that?
No, you hit on many of the points that I also wanted to say. But Paul, you're asking the big question here, and we haven't solved the risk question yet. The only thing is we've talked about it a lot, and that's how we've discovered Kita, which is, as Hayley mentioned, a startup that is starting to get into insurance of these carbon credits. So once you can insure the risk for both sides of the agreement, that's like a great step forward. Another thing is, indeed, you can get the inspiration from all the Web3 projects that are currently doing these forward models. So, as I mentioned, Ivy Protocol is our favorite. And what we like so much about them is that they have their own pool of validators, which can really stand by the side of these very early stage and risky projects and help them through these stages. That's great. But there's also things like CarbonFi, and they have a DAO, and the DAO there decides on which projects get developed. So that's their way of de-risking. So they're all doing something a bit different, buffering, pooling, but we are not so much in favor of the pooling approach. Although it's good for de-risking, it's not very good for the value of the project. There's different ways, and I think it's very interesting to talk about it, and it's very interesting to check out what different companies are doing. Yeah.
Right. Nathalie, there's the debate that rages within the VCM world is whether we should think about carbon as or carbon offsets. Do we think of them as a commodity, or should we think of them more through the lens that they're actually like corporate credit, where there isn't, and the difference being the level of standardization across those products? Can you talk a little bit about sort of how much standardization you really need in this scaling process, right? Because again, I have very strongly held views that you shouldn't think of carbon as a commodity, that the carbon offset should be viewed in the same vein as corporate credit, which does have a distinct lack of standardization across the board, which, according to your means that OTC transactions are going to be more prevalent than futures contracts, right? So talk about how you think about standardization and the scalability of this market.
I think we agree on this, Paul. I think if you commoditize carbon, you actually lose value of the best projects, because per definition, you only want to pay for the pool, the value of the cheapest project, let's say. So you have no incentive to put a great project into a pool. So that's why we are against the commoditization of carbon credits. But of course, I mean, this is a paradox, right? Because you need liquidity to scale the market. So you need some form of standardization. So I think it would be great if we can standardize the way forward contracts are made, so that it's easier for both parties to engage in them. And so that's why it's good that these platforms are being developed, where you can just enter these forward contracts and these platforms have experience with it. And I think it would be great if we show all the different attributes of each project in the same way, like on an exchange as Thallo, where you can compare the co-benefits, the vintages, the location, the type of project, the rating. So in that way that you can compare them and they have a different price, so we get price transparency. But I really think we should keep the characteristics of every project, because they all have different values, and also different values for different buyers. So that's the way I think about it.
Yeah, and particularly
on that point. Oh, just to add to that point. So for the Thallo exchange, we have pioneered this model called dynamic pooling. The idea here is that pools can be valuable. If you pool a bunch of credits that have similar attributes, you have that additional liquidity. However, if you kind of blunt force create your own pool, say Thallo comes up with our own definition and puts all of the credits that meet that definition into a pool, then you're fragmenting liquidity on a platform. So what dynamic pooling allows for is that the buyer who is looking at our platform can set their own parameters, their own filters. Say they only want to look at cook stove projects in Uganda that have a vintage of 2020 or later. They can filter for those and get a pool of all those credits, and then an aggregated price or an average price for that pool. So that is one model that works with the carbon credits that have already been issued. And it's possible we might be able to innovate something similar with forward type of contracts. But again, it's very early. That's something that we'll be looking at down the line.
Right, because to some extent that sounds a little bit like the whole notion of a dynamic ETF in some ways, right? Where you can so literally just come to say, and these, I have a portfolio that I want to develop in terms, as you said, Ugandan Ugandan cook stoves with post 2020. It's a really neat solution to that if you want to get some sort of broad exposure. Particularly, and this is what goes to my next question: is how does I think the revolution that comes with VCM is going to stem from SEC disclosure requirements of Scope 3 emissions, where suddenly corporate treasurers wake up one day and go, oh my God, the world actually knows what my Scope 3 emissions are. I need to offset that. And how do I do this, right? Let's talk about how you've thought about that sort of demand spike that potentially could come and and put that in the context of the bottlenecks that you talked about.
It's a great question. And what will happen with demand will, as you say, be affected by things like regulation and disclosure requirements for corporates particularly. It's important to note that corporates right now remain the largest buyers, the largest demand segment for carbon credits. I think corporate buyers are over the 95% of all of the purchasers of carbon credits at the moment. So they really are driving the demand. That said, demand has been a really interesting thing to follow if you've been following it over the last few years, because there have been spikes and troughs, and that affects prices, and that affects kind of what the market looks like. But because these timelines to actually issuing carbon credits are so long, as Nathalie pointed out, it's the supply has to anticipate what that demand will look like. So I think where we are now globally as a market is that there is a constrained supply right now, and a lot of these project developers are looking to expand their carbon credit delivery for the next few years, expecting to see that spike in demand. And I think that's the right move. I think we will see that spike in demand, and I think there will be a supply crunch. And if you're a carbon credit developer, you're in a good position if you can deliver credits when the market is otherwise constrained. But it changes month to month. And so it is also very tough to make those types of agreements, because if you're a carbon credit developer or carbon project developer and you're agreeing on a forward contract today versus 3 months ago when credit prices were much higher, your leverage looks totally different. So I think it remains to be seen how things will shake out. There are a lot of dynamics at play in the market right now, not the least of which are these new entrants in the Web3 space that are looking to solve some of these problems. Some of the projects are increasing fragmentation, in fact, and exacerbating some of those problems. But I think the carbon credit market will look very different in 2 or 3 years than it does today. Another factor that will have a big impact on demand is what happens with defining quality. There are several initiatives going on right now, like the ICVCM and on the supply side, and then on the demand side, the Voluntary Carbon Markets Integrity Initiative. And that is looking to basically give guidance to corporates on how to use these carbon credits and how to talk about them. So how those organizations are able to kind of solidify around easy to follow instructions. SBTI is another one that's doing this. That will, I think, dictate very much what demand looks like over the next 18 months.
Right. But again, Hayley, what you've just described is how every market in the world works, right? So, put it this way. So I may have a view on Microsoft over the course of the next 5 years. If I had bought Microsoft 6 months ago, I would have paid a hell of a lot more for Microsoft than I would today, right? Where my views 5 years forward may not be affected at all. That's just price gyrations that you just alluded to. That's the nature of any market, and that's and VCM is going to be no exception to that.
Sure, absolutely. And I think the thing that's unique about the VCM is that there's all of these new entrants in the market that have never touched it before. And so there's all of this strange price activity that's happening simply because you have entities saying, well, what if we buy carbon credits? Or on the flip side, what if we create a project to develop carbon credits, especially in the technological space? So again, I think there's a lot of dynamics at play. It looks like, Nathalie, you have a thought that you wanted to chime in with.
Yeah, exactly. Because you asked about the bottlenecks and the role of them in this question too, Paul. And It's interesting because the bottlenecks have only started, with the verification. These bottlenecks have only started arising in 2020 when there was a huge increase in supply of these projects. And I think that's because, the market is becoming more attractive and everybody's speaking about the supply crunch. So more and more people get into it. And secondly, this is also part of the reason for the verification delays, because the new project developers, they are less experienced and the quality of what they deliver is not as good as the very experienced project developers who have been in this for 20 years. And so the VVBs have to do more work, the registries have to do more work and have to push back. And that's also why all these delays are arising. That's one point. And the second point is there's also more and more methodologies arising for offsetting carbon. But the problem is the crediting programs just don't have time to develop standards for these new methodologies. So it can take up to 3, 4, or 5 years. And that's another problem in the supply crunch. And still TBD how that's going to be solved.
Got it. Tim, we have a slew of questions from the audience. From Norms, during COP26, the fair retirement of credits was a major talking point. What mechanism does Thallo use to ensure that carbon credits are fairly retired and not double sold?
Great question. I think this is one of the areas that blockchain is really excellent for, in fact, because the whole point of having a public ledger is that you actually can't do something nefarious on that ledger. Everyone can see what action has been taken. So the way that Thallo approaches this is we work directly with the carbon registries. We have just announced our first big registry partnership, which is with Biocarbon Registry based out of Colombia. And essentially, we have an API directly with that registry so that anything that happens on the blockchain gets recorded directly in the registry and vice versa. So, for instance, if you buy a tokenized carbon credit from Thallo that has been verified by the Biocarbon Registry, and then you retire that credit, that immediately gets communicated simultaneously back to the registry, and that credit is listed as retired on the registry. The token actually gets immediately burned, and a proof of retirement NFT is generated. So this is the type of thing where concerns around double accounting or double spend or anything like that actually get alleviated if you are able to tokenize the credits directly with the registry themselves linked up through a two-way bridge.
Interesting. Let's talk a little bit about, actually, there are a couple more I want to get through. No, we're definitely not asking that one. Definitely not asking that one. Do you think Web3 can be a tool to accelerate funding through early? I think that's meant to say feasibility studies. And also, do you think that they could be a tool for making the funding cycle more fair and inclusive? And
definitely.
It actually says away from middle-aged white guys like.
Great question. Love the framing. I think absolutely. This is exactly where Web3 thrives. And I think it does so for two main reasons. One, the whole promise of Web3 is around democratization. Now, whether or not that's really been realized is up for debate, because who's actually using blockchain at the moment? It looks a lot like tech communities. It looks a lot like finance communities, which are those profiles that this person highlighted in the question. But the idea is that you can have this sort of decentralized governance, for instance. So everybody who holds a token and is participating in an ecosystem can have a vote about what projects get selected, what funding happens. Secondarily, I would say, maybe there's three pieces here. Secondarily, I would say, there's also this appetite for crowdfunded type of solutions. So one of the things we talked about early on was folks who are participating in, say, a staking pool may be receiving yields that they would like to reinvest somewhere else and have something good happen out of it. One of the projects that we really like and that we partner with is called Spirals Protocol. And they work by essentially allowing people to stake their stable coins, and then the yield that they earn on that, the protocol allocates to specific carbon projects, and specifically to early financing of carbon projects, because it's sort of a pool of money that they're able to decide what they want to do with. Meanwhile, the community gets to vote on which projects to allocate to. And then the third and really interesting dynamic is that we were talking earlier about risk. And I think most people realize that crypto investors tend to have a higher risk tolerance than perhaps traditional financial investors. And so you have this interesting dynamic where it may be, and this is not something we have backed with data yet, but it is a strongly held hypothesis, that it may be that crypto investors or folks who are in the blockchain space or Web3 space are more willing to make what appear to be riskier bets, which are earlier stage financing for these projects. So I think because of those three dynamics, there's actually really good support for Web3 as being a really natural partner to early project financing.
Got it. But that goes back, Hayley, that actually answers a lot of the questions that we talked about before the call about the risk profile of early stage funding, right? So, and again, we shouldn't care as a VCM ecosystem how that early stage funding gets done. If it happens to come through a bunch of crypto mavens, fantastic. We don't care about that. If it comes through grant funding, we shouldn't care about that. But is there a way to institutionalize that early stage funding in the crypto realm, right? Is this something that Thallo's thought about in terms of providing a platform for dedicated that earliest of early stage funding to solve that risk issue that we talked about earlier?
Yeah, well, and there are lots of ways to solve that, and a few that we've been looking at are things like having a community fund where folks can make decisions about allocating funding to early stage projects. Another is that you can do, and I think we have to be careful about this, but I think you can do kind of a portfolio style investment, which helps distribute the risk across different projects. So for instance, if you have a funding pool, which is again something we've looked at for Thallo, it won't be an early part of the exchange, but a potential later feature would be if you have a pool of funds that have come from either staking yields or have come from even donations, as we talked about with some of these other protocols, then that pool can be allocated to things like early stage financing. So I do think that it's a solvable challenge, and there's ways to kind of defray that risk across the portfolio, so it's not as risky of an investment.
Got it. And particularly if you put it in the context of taking a percentage of that pool and utilizing a service like Kita, for example, to actually ensure this early stage funding, you can actually mitigate. You can go a long way to mitigating that risk, both in terms of dispersing that risk, but also having an underlying insurance underpinning as well.
That's right. And the due diligence piece is really hard. It's worth saying. That is very challenging. I know one of the organizations that we've talked to quite a lot is Solid World DAO, and they have when they launch their product, they will have a due diligence team working on making sure that the projects that they invest in are worthy projects. But that process is very, very challenging, and it's hard to get the right data. And I think one of the other promising and exciting areas, and I did see someone ask a question about this, is around DMRV, so digital MRV, and I think there is a future scenario in which all of the data that comes in about carbon credits, because a carbon credit supply chain is basically a project happens and all this data starts getting tagged to it about the project. And so if you can do that on chain and have that be a digital process, then suddenly everything becomes a little bit more transparent and a little bit fairer and more democratized, because you don't have to kind of wait until the registry issues a credit in order to see all the documentation for it. You might be able to see things like real-time satellite monitoring of a forest that is protected by a particular project. So I think there's a lot of potential there. Again, very, very early days, but I think that's another area that may help with some of that risk mitigation, because people will have more direct access to the underlying information about a project that they can investigate themselves or look on a blockchain storage area to try and see like what type of information exists about that project.
What you're describing is also very nicely executed by Ivy Protocol. It was also, maybe I didn't mention during the presentation, but the project developers who have their project on the platform of Ivy Protocol, they can earn extra money if they give updates about their project and the development of the project. So this is basically what Hayley was saying, that they can get direct access to the MRV and they can earn money off it.
I'll paraphrase Laura's question here, Tim. The $4 a ton for a VCM project just probably doesn't cover cost for many project developers. Obviously, we've made this. We, being the VCM ecosystem, has made the decision that pricing will be market determined. What outside of the demand spike that we've all been alluding to? What's the driver of getting carbon pricing in a lot of ways more reflective of where compliance markets are, for example? What bridges that gap?
Yeah, I mean, there's a number of factors. You mentioned one earlier, which is disclosure by companies. I think there's increasing, shareholder activists, shareholders, and customers for corporates that are demanding to see what types of carbon credits or what types of sustainability initiatives companies are coming up with. So I think that's a major driver. I think other drivers also include just the maturity of the market and the maturity of education around the market. As I mentioned earlier, there are more informed and educated buyers at corporates and at investment firms around carbon than there have ever been. And so the more education that there is, the more there is discrimination and price discrimination for different types of projects. And so I think what we'll see is the prices become more stratified over time. So you have very high quality projects that actually command a very high price premium. And I think you will have a lot of carbon credits that remain very low priced. And there is a demand for those. I mean, airlines tend to buy those. That may change after CORSIA comes into compliance effect in 2026. But I think you'll see that kind of increasing stratification. And the result of that is that project developers who can do those high quality projects will be incentivized to do so because that sort of ceiling price will continue to go up. I mean, it's very attractive if you're able to implement a direct air capture project today because you can get $1,500 per credit for that type of project. Whereas if you are a small local project developer that's doing AFOLU projects in Brazil today, that might actually look really bad to you, and you might have to make some decisions about how you will go forward and if you will go forward at all. So I think that's the type of price action that we can expect to see based on those drivers of demand.
Right. But that also doesn't bode well for futures contracts and standardization.
Correct. That's why this is so challenging. Exactly. And it's that variation. I think Nathalie spoke about this really well, that variation in project type, in methodology, in vintage, in experience of the project developer, size of the project developer, type of investment. I mean, it's all quite varied. And that's why ultimately the demand side buyer needs to have all of that information in front of them so that they can make an informed decision about whether or not they want to buy a particular carbon credit or invest in a particular carbon project.
Right. So at the end of the day, what we do need is in the development of forward curves in general, they will, again, I'm not making a judgment on whether ICE and CBL will make, these will be profitable businesses for them, but at a minimum, those forward curves will give the level of price transparency that we need for developers to be able to sell forward with confidence.
Yeah, I think that's a big factor there. Project developers don't know what price to charge for their carbon credits today, particularly smaller ones. So we are hearing when we talk to project developers, they say, what do you think I can sell this carbon credit for? So there's just this incredible lack of price data. I mean, Ecosystem Marketplace is a great resource and kind of one of the primary resources for carbon credit pricing data. And they get their data by putting out a survey every 6 months and saying, did you buy carbon credits? How much did you spend? What did you buy? So that's not a very useful, it's as useful as it is in the market right now, but we need more useful and actionable and real-time data about price for project developers, for end buyers, for traders in the market. And that's something that, on a blockchain-based exchange like ours will be totally transparent and help provide some of that pricing signal to all the players in the market.
And Hayley, just to take that one step further, do you, in terms of your pricing models, I know there's companies like Viridios, for example, that are doing model-based predictions on forward curves, which have the limitations of being model-based. Is Thallo looking at are you going to be basing your pricing exclusively on transactions, or will there be a model-based approach as well?
Yeah, so our initial platform is just for credits that have already been issued. So it won't actually include forwards at its initial iteration. So in that case, the project developer is the one who decides what to post their project for. And then the prices that are available to everybody who's on the platform are the prices at which the transactions are executed.
Got it. We're going to try to squeeze a couple more questions in here. Just a quick question on Thallo. What blockchain are you using to build the platform on?
So we're multi-chain from the start. We are going to be building on and deploying different parts of the exchange on Thallo, Polygon, and then also XRP Ledger.
Got it. Team, we're running out of time. Now I'm going to leave. Obviously, I'd like to leave it with you in terms of the last part of this. So, I'm assuming you took months to put this together, right? And you guys need to be really congratulated on the paper itself. When you sat down, when you finally sent send, right, and you actually published this report, what were your key takeaways of the report in terms of whether it's levels of optimism, whether it's some of the things that you find challenging? When you sat down and finally were able to take a breath, what did you come away with?
Oh yeah, the key takeaway.
Some thoughts here. Yeah, no, please go ahead.
Yeah, the key takeaways are, of course, that this is huge, right? These verification delays, they need to be solved one way or another. And also the intermediaries, there needs to be a better solution for it. My personal takeaway, and I think also for Thallo, is there were two phases in building this report, right? The first one was interviewing, and gathering information. And then we had the first draft of the report, which we then showed to the second half of the interviewees. So we used the first draft of the report to open a conversation with the second half of the people that we interviewed. And this was actually even more interesting than the first number of interviews that I've conducted, because it opens such an interesting conversation, and it confirms that everybody has the same problems, and it confirms that everybody's thinking about this and trying to solve this. I think that the best part was just talking about this with Vera and Gold Standard. They may not necessarily agree with everything, but they do agree with some parts of this. So this is great that even they are aware of this, and we can have this conversation. Everybody should work to solve these problems.
Yeah, I think that they are. Sorry, please.
I was just going to say, I think my key takeaway is that it's always important to step back and look at the larger picture. The goal of the voluntary carbon market is to get more carbon out of the atmosphere, or keep more carbon from going into the atmosphere in the first place. And I think looking at the proliferation of projects that are working in this space, it's a great thing that there's more scrutiny on this market. There's more players involved. But at the end of the day, it comes down to the project developers. Will they be able to execute these projects to get more carbon out of the atmosphere? And I think anyone who's working in this industry should think about whether or not their project is helping reach that end goal. Obviously, there's money to be made. Obviously, there's markets to be created. But at the end of the day, our shared goal is to try to stop climate change and reduce emissions. And I think that should be the guiding star for anybody who's working in this sector.
Yeah, for sure. That's amen to that. I think that's again, if that's the true north that we all have to follow, then I think we're going to be in good shape. Nathalie, Hayley, thank you so much. Do you mind if we send this out? Can we send the report out far and wide? We pop it on.
Please,
we'll pop it on Climate Transform. We'll send it out. We'll send it out in this week's newsletter and make sure it's goes out to everyone. But Thallo.io to view the report. Hayley, we'll do this again soon. And Nathalie, congratulations on a great report. It's get some. It's getting late for you, so get some rest, and we'll chat to you all very soon.
Thank you, Paul. Send it far and wide.
Really appreciate the time.